Ladies and gentlemen, Christopher Aaron here. Welcome. It is January 2nd, 2019, and it looks like we have something of a market dislocation tonight. I want to take a look at that. Something is happening in the currency markets during the overnight hours, and let's see how that impacted the precious metals. I am glad that you're here in the new year. This is going to be an exciting year. There are a lot of things coming up on my schedule personally, and there's a lot of new content that I want to create for you. And on that topic, I just wanted to bring up if you voted last week on the question that I asked, I appreciate that. I wanted to let you know ahead of time. I appreciate that. Let's just take a look at the vote really quickly here. And I asked people to give a thumbs up if they wanted me to cover other related markets to the precious metals here on this channel, and a thumbs down if they wanted me to stick with only gold and silver. So I want to let you know that I've really taken this vote to heart. I mean, it was fairly close here, a few hundred more on the yes side, but fairly close in the grand scheme of things. And I know we have a real dedicated and passionate group of individuals here who understand some of the deep fundamentals behind what is happening, not just in the economy, but in the world at large. You know, we're really talking about a real human discussion here about the savings and value of our savings and the purchasing power of our savings. And so I want to let you know, as we look to expand this channel, I am going to start including new markets here in this channel. And the best reason that I can explain is if you think about it, it's like a hurricane. Imagine if there is a hurricane coming, you know, for example, to North Carolina or the East Coast of the United States. We can't just look at the weather forecast for the East Coast of the United States where the hurricane is going to hit. Why? Because the hurricanes originate offshore. They originate off the coast of Africa, you know, a completely different continent. And then they travel across the Caribbean and they intermix with other weather systems. And then they hit the United States. And then you know what happens after they hit the United States? They travel up the east seaboard to Nova Scotia quite often, and then they cross the Atlantic again back to the British Islands, and they end up getting these tropical depressions over there. So everything is related here, but what I wanted to express to you is that I will not be making videos that say gold and silver in the title and then discussing Amazon stock or something else like that, okay? So I'm going to try to make these videos as accurately titled as possible. So if you're interested in the related markets that are all coming together to impact the expectation that we have here, you will know about it. And if I'm strictly going to be speaking about the metals, you will see that in the title. So I hope you can stay with us and enjoy some of the new stuff that is coming here in this channel. And thank you, as always, for tuning in. So let's get into it. What is this dislocation that I was talking about tonight in the markets? It turns out that Apple, and so this is, you know, we're talking about this right away. Apple Computer, right? How is this related to the precious metals? Well, Apple released a revised forecast after the market closed tonight, and they said that they were lowering their guidance, especially related to the sales of smartphones, where? Out of China. How does this impact the precious metals? Well, it does. It's all related. So what happened is, as they lowered their guidance, Apple stock, by the way, is down about 8% just after the close. Okay, so 8% down. This is causing a fear reaction amongst a lot of these markets. And one of those markets where we often see this fear reaction playing out is in a currency cross pair. And we're looking at the value of the US dollar versus the Japanese yen. Okay, and we're seeing the dollar sink versus the Japanese yen. Now, this is the single largest move in the value of the dollar versus the Japanese yen in 10 years in one night. Okay, so something here obviously important is happening. Now, if you've been following this channel for a while, or perhaps, you know, reading some of the articles that are posted on Gold Eagle or on Bullion exchanges, or if you're a premium subscriber, you will know that we often talk about this relationship with the US dollar and the Japanese yen as it relates to gold. And these are related. All these things are related. So we started with Apple computer stock giving the markets a scare, causing a fear reaction in the US dollar, which what conversely is good for the Japanese yen. And what we've said is good for the Japanese yen has been what? Good for gold. This is the relationship that we've been observing for the last 7 years, that gold and the Japanese yen have been moving very closely in lockstep. So everything is related here. And then we switch over to silver, and by default, because silver, we were talking about this last week, that it had exceeded that $15 level on a technical basis, and that set it up for at least a dollar move higher. So silver is taking the advantage. It's not performing quite as strongly as gold here in the overnight hours, but silver is in a short-term breakout mode. Okay, so that looks good for both metals. Even though typically in a fear reaction, we see silver often lag gold. Now, silver looks like it could target $16 over the next couple weeks, and then I will tell you a much more important transition point will come here for the metals. When silver starts closing in on that 16 level, it's going to be much more significant than even that break of the 15 level. Of course, we're all talking right now just short-term little things. So where does that leave us with gold? We see gold hanging in there, closing in on 1290. Silver is in a short-term breakout. Where does this leave us? Do we have to make an adjustment to the model that we've been studying for the last 5 months or so here from a technical basis? Let's bring up the model. There are some changes. But before I want to get into that, I want to bring up this analogy. We were talking about the hurricane analogy a moment ago with relationships between markets. And I can already hear some of you out there, and it's fine. I've got tough skin. To be publishing this stuff online, you have to have tough skin. But I can already hear some of you saying, oh, see, the model has changed. So from a technical basis, the model has changed. Therefore, you can't know anything from technical analysis. Right? And we'll look at the model. I'm going to move this out of the way in a minute. But I want to address this concern before we even go any further. And I want to tell you how I approach these markets, okay? And then we'll look at some of the fundamental arguments as well in just a moment. But from a technical basis, when we are talking about a model, a technical model, the way to think about this is it's comparable to a map, okay? And in the earlier part of my career, I created maps for the intelligence community overseas while I was in Afghanistan and Iraq. And this is not one of those maps. Those are classified. But this is an unclassified map of what? New York City. Okay? And what specifically are we looking at here in New York City? We are looking at pedestrian traffic around New York City. Okay? This is the island of Manhattan. This is Brooklyn down here. We would have Queens up in this direction. We're looking at the volume, how much pedestrian traffic, we're talking walkers, joggers, etc., and where do they go in Manhattan. So you can see from the darker colored lines here, the red lines, for example, individuals tend to, through a study of human behavior, they tend to walk on the outside of Manhattan. Can we see that? And where's the other place that they tend to walk is around Central Park. You can see that right here, the bright red, right? Now, where are some places they don't tend to walk that often? Sort of here, lower financial district, okay? Midtown, lower Midtown, they don't tend to walk there that often. They don't tend to walk in some of the boroughs here in Queens, for example, as often. So here's the map. Here is the highest probability assessment. Based on what? The only thing we can base this off of. An assessment of the past. We're observing the past, and we're saying, based on the past, what is the highest probability that we can expect for the future? What other information can we ever derive any prediction from in the future if it's not based on an observation of the past? So imagine one day we have this map. This is the highest probability. And imagine one day we see a parade. And maybe it looks something like this. I don't know. This is kind of a nice thing to imagine. So we see this parade walking right through the middle, and we see 20, 30, 50,000 people walking right through this blue zone here, where the map shows there should be low pedestrian traffic. What do? Do we throw out this entire map for the rest of eternity and say, because one time something happened here that changed the outlook, do we throw the entire history of our observations away? Of course not. That would just be silly. That would be self-destructive. In fact, it would be against your own interest to do that, because more times than not, when you're in one of these areas, you're going to see the high pedestrian traffic. So bringing this back to the gold market, we have this map. The trend here from 2015 through the bottom. Now, by the way, I don't have the regular chart yet because we're seeing this action in the overnight hours. So this is my overnight chart. It doesn't look as pretty as the regular charts, but just follow along here for a minute. We're looking at the trend break that we saw right here, that the market back in July of 2018, that the market is now attempting to overcome. Now, we usually want to see 2 weekly closes of this level here before we can really call it a legitimate recovery. So we've seen the first weekly trend, although it was a holiday week. This is a slow week. You got to be careful how much faith you place into these holiday breakouts. I'm telling you, the first real week of trading starts on Monday, next Monday, when everyone gets back to their computer desks after being away wherever they were for the holidays. So we're seeing the attempt at a break back above this trend, and this has to bring into question, is this trend still valid? So we are going to know the answer to this by the beginning of next week, by next Monday. Please stay tuned. If this is not valid, once again, do we throw away the rest of the observations that we've been making here on the gold market for the last 3 years? I would tell you no. Why? For example, this is the system that we used to identify, this is when this channel began. This is when I began publishing information right here in August of 2015, okay? Right here at this green arrow. There is a reason why I began to publish here in August of 2015 and not, for example, in 2012. And I would simply, now I've never deleted an entire video from the entire publication here. You can go back and watch some of the original videos. But I would just ask you, if you're one of these people that wants to say, we have a new data point, perhaps, let's see how the weekly close can finish this week. Let's see if gold can hold this recovery. If you're one of these people that wants to then completely ignore technical analysis, I would just go back and ask you, what were some of the fundamental-based channels saying back here at the peak in 2012? Were they saying gold's ready to skyrocket, or were they saying, no, gold had broken a parabolic trend and is looking to move lower for the next 5 to 7 years? Okay, here's where we started publishing. This was entirely based on technical analysis. The fundamentals have been in place pretty much for the last decade. It's when does the market begin to change its behavior? Now, what is another one of the signals that's giving me reason for caution? As a reasonable individual that likes to look at data from both sides, what is one of those signals, again, that we're seeing? It's a relationship, unfortunately, between the gold mining complex and the price of gold, GLD proxy here on the bottom. Look over the last month, for example, how as the price of gold has been clearly rising, follow these days here between this peak on the 19th and this peak just on Christmas Day, the day after Christmas. Look at this higher peak in gold and look how the gold miners completely discounted it. Once again, another peak leading into yesterday, and we'll see a new peak tomorrow. And look at how the gold miners actually made a lower peak. So the gold miners are flat to negative since December 18th, while the price of gold has been surging. So there's this divergence. There's a divergence, across the board. There's a dislocation happening in the markets overnight. The Japanese yen is surging, causing gold to surge. The gold mining sector doesn't believe it. We see a partial recovery of a broken trend. There's a lot going on, suffice it to say. This is why we look at this each and every week to the best of our ability to try to align with these trends, especially important when there's conflicting data approaching a major resistance level. Now, I promised that we were going to do a 2018 review. And I just wanted to do a quick high-level review to show you also. And this is a challenge again. This is a challenge to ask you to go check out some of the other channels. Go back to the beginning of 2018. Who was saying gold was going to skyrocket in 2018? Silver were going to skyrocket. Who was not? So we did not see a skyrocket in gold nor silver this year. The US dollar finished best out of these major asset classes that we follow. Now, this is still fitting in line with, from my perspective as an independent investor, even the slightly negative performance here in gold and silver are still fitting in line with a bottoming process that has to unfold for these metals, that also has to unfold for the commodity complex, a bottoming process, right? Which can take a number of years to play out. We've seen this since 2013. And so the question is, we're getting ready to ask, when is this bottoming process going to round up? And I would say whether or not gold can recover this broken trend is going to have a key impact. Are we going to see that potentially in 2019, that break above 1375? The peak from 2016, we've been looking at this for almost 3 years now. Is 2019 going to be the year? I would say what happens here over the next week is going to be giving us a lot of important clues to that. And if that's the case, then these gold miners that underperformed, and we can see why they underperformed, right? Because if stocks are lower for the year and gold miners act somewhat like stocks, and if the S&P if gold itself was lower, then when you multiply gold times stocks and get gold stocks, they typically multiply these losses. Okay, so it's important to follow the diverse markets that we see here, especially if you're going to be involved in the leverage side of things. Now, important things coming up over the next couple of weeks. I'm glad that you're here. This is going to be a very exciting time, 2019. I think it's going to be an exciting year. I think we'll have, my prediction for 2019 is that we will not see a skyrocket in either metal. But I would tell you that I believe the answer to that question, whether or not gold can negate that breakdown here and prove it over the next week, and let's say it holds it into next week, especially the end of next week's close. If we can see that, I think 2019 is setting up to be the final year of basing for the metals here. The final year of basing. And that 2020 may look to be that year where we get that real pop. We get that real pop. Gold starts challenging 1,500 again. And we'll talk about silver. We'll see how much it's lagging. Does silver get back to 21? Does it get to 25 at the same time that gold is chasing the 1500s? We'll see. Lots to talk about. Next week, we'll look at some diverse markets, and I really hope that you can understand why we're going to do this. The final reason is I just want to appeal to all those people who hit the dislike button on the vote, which I appreciate. Appreciate your vote. But I want to talk to you for a minute, and I want to propose that question that we were talking about last week, which is, what happens 5 years from now, 10 years from now? Let's say that we are right. Let's say that gold in 2020, after it finishes basing, gets up to 1,500. And within the next decade, we're talking about gold at 5,000 or 7,000. And we're talking silver certainly above 50, and then starting to climb its way above 100 and maybe a target of 300 or something eventually. Let's say that happens in the next decade. What then? What then? So I would like to start preparing ahead of time by monitoring other markets, because there will come a time, if you're a prudent investor, that you will take some money off the table in precious metals. And I hope to just simply start establishing a reputation, a rapport with you that we can cover other markets and we can align with probabilities in other markets. So there's a lot of that coming. Please stay tuned. I will be speaking at the Vancouver Resource Investment Conference in 3 weeks. I'll have more details on that next week. I'll provide a link to that, but I just want to let you know ahead of time. That's coming up on January 20th in Vancouver, British Columbia, Canada. So if you're there, mark it on your calendars. I would love to meet you. Thanks for tuning in this week, and I will see you this time next week with some new market coverage. Thank you. Happy 2019.